The number one issue that portfolio managers have been asking us relates to the prospect and probability of a recession in 2020. Now, our view at Goldman Sachs is that's unlikely to be the case. There's certainly a risk around that.
You say 30% risk of
there's
14 times.
Certainly there's a possibility that you could be in recession, and therefore the market would trade on that. But the broad central thrust and the central case is that we're not, and the economy continues to grow at a decelerating rate in 1920. And that would be consistent with the market staying around these levels in multiple terms, and therefore the earnings growth would take you higher.
So what's this 10-week or so sell-off been about to you primarily? And how do we know whether it's over?
Well, the bond yields went up almost 40 basis points at one point, from like 280 to 327. They've come back in at 305 now, but basically that was a particular risk we've seen in the past when rates jump at a fast pace. That would be one big issue. There's certainly concerns about tariffs, no question about that. But from a valuation point of view, the market has come down, once again to a level that is more consistent with the underlying activity that we're seeing.
So these threats for Chairman Powell, I don't know if they're threats, but complaints from President Trump about the Fed policy and the Fed chairman personally, is that a market risk?
Everything's a risk, but I would not put that as a central concern that we have. There's a lot of concerns we focus on. I'd say near term is tariffs.
You just see it as noise and not a question about Federal Reserve independence?
No, I think the issue is what's going to affect the level of earnings. And corporate balance sheets are highly leveraged. They've become more leveraged now than they have been in the last 35 years. It's a reference you made earlier on the release of the Federal Reserve assessment. That's one area of risk. But other areas, in terms of the consumer balance sheets, have deleveraged dramatically, and that's an important part of activity overall. So that would be the one area. The three risks that we are concerned about would be: one is tariffs, two is labor inflation and the pressure on margins, and the third is higher rates. And that's the three areas of concern. But the fundamentals remain pretty strong. And our focus really is on higher quality companies at this part of the cycle. Now, you can debate how late we are in that cycle, but quality company, you can define that in different ways, but you can think of that as strong balance sheets. You can think of that low historical drawdowns. You can see a consistency in terms of their revenue growth, in terms of their earnings. Those are some of the attributes we look at, and you can see a variety of companies that meet those criteria.